Welcome to the InterMarket Analysis video update. This is a video that I do once a week where we look outside of the S&P 500. We look at other indexes within the stock market. We compare sectors with the S&P 500. And we also go through and look at the current valuation on a historical basis, as well as looking at a forward basis for valuation to try to get some clues about what's happening within the S&P 500 itself. This is being prepared for Monday, May 20th. The first area is valuation. We start off by looking at a historical chart. This is called TTM, or the trailing 12 months. These are earnings reports that have already been released, and they're part of the historical record, so to speak. And what we can do is we can compare the current price of the S&P 500 with what past earnings were, and that gives us some different ratios. We have a PE ratio of 10. When the S&P is at that level, it's considered to be inexpensive or cheap. 15 is when it's more fairly valued, and 20 or above, that's when the market is considered to be expensive. Right now, we plot this with the current S&P 500 and the PE ratio of 20, and you can see we're well above this PE ratio of 20. So on a historical basis, we are overvalued, but we've been that way for quite a while. And you can look back on this chart and see that the market can be this way for many years. We also can compare this to different events that have happened and what the valuations were on a historical basis at that time. And then we take another approach developed by Robert Shiller called the PE ratio, either that or the CAPE, C-A-P-E, or CAPE 10 or PE 10. He takes a more averaged approach in his calculations to try to get a more smooth effect with what the current PE ratio is. And right now it's coming in at 34.7. Well, to get some context, we can look at a historical chart. We can also look at the median and the mean, and we're right anywhere between 16 and 17 for the median and mean. So we're about double what we are usually at on a historical basis based on the Shiller PE ratio. So stocks are looking expensive. But as I said, we don't use this to make decisions. We would just want to have a good idea. What is the current climate like? To give us an idea. Now, there are some investors who do base their decisions around this. They're more fundamental. They use fundamental analysis in their approach, and they might be really nervous about getting in the market right now. And they typically will look for either indexes, stocks, sectors that have a low PE ratio, get into that, and then decide to get out when it gets up to a very high PE ratio. But I use this in a bit of a different way. This is more just for information to give us some insight as to what's happening. But the market doesn't do that. They look forward. And so on this chart that's put out by Edward Yardeni, this looks at forward PE ratios, and that's what the stock market uses to justify prices going up or down. The red line is the S&P 500 coming in a little bit above that 20 level at 20.6. Then we have the mid caps, which are coming in at about 15.7, so they're more fairly priced. And we have the small caps, which have really lagged behind in 2024. They're coming in at 14.7. So some folks might think, well, now would be a good time to get into the small caps. Based on this chart, yeah, that might look like a good idea. And the mid caps have been pretty strong in 2024. But we want to use other charts to confirm this, to see, is this a good time to actually enter these other markets? I mainly focus on the S&P 500, and we are a little bit expensive looking out at the current time. Another area that we look at is growth versus value. When we were coming up out of the bottom in 2022, we saw growth really outperforming value. Before we went into that difficult year of 2022, we saw value outperforming growth. Well, we're not really seeing that on a ratio basis right now, and this is causing a little bit of concern. We're setting all-time highs with the S&P, the Dow, the NASDAQ 100, and other indexes, but we're not really seeing growth really outperforming, and I'll show you that as I go through this. The first area that we look at is just a pure growth index, and this is in an uptrend. We did have a downturn in April as the market was pulling back, but now we're starting to come back up. We also look at a pure value index, which is in a more solid uptrend. And that's not typically what we see when the market's really going up higher. We want to see growth outperforming value. So in order to do that, we look at ratios. And growth is outperforming value, but it's not really screaming to the upside. It's in an uptrend and it is doing better, but we would want to see this go up more than what it's doing right now. So this is just a little bit of a warning sign to us, just to be aware of this. And I have a lot of other growth to value charts to show you. And then on the bottom, I have an inverse because sometimes these calculations are off just a little bit. And sometimes you can get some insight by looking at that same chart flipped upside down. And this also is showing where value has been underperforming growth. There's another way, using a couple of ETFs, looking longer term, we do see where growth is outperforming value, but it's like everything is going up right now, and even value is seeing some real push higher these days. And so growth is not really outperforming the way it had been over the recent past. Here's an inverse of that same chart showing how value is underperforming growth. Here's those same indexes, the pure growth indexes, longer term. We do see the blue line coming down, but growth is still outperforming overall based on the trend. There's a little shorter term look showing how value is outperforming growth. Excuse me, how value is underperforming growth. And then here's another index that we look at showing how growth is outperforming value. Then we take a couple of ETFs, and I've been showing this lately in the daily videos just to see how is this acting. Because when we were going down in April, we came right down to this 250-day moving average, and then we were able to bounce up off of that. We came right back up to the top end of the rainbow, but now we're kind of settling near the upper end of the rainbow, but not really breaking out at this time. And here's that same thing, only inverted, showing how value is underperforming growth. We didn't quite get up to this 250 period moving average, but we're still inside the rainbow itself. Then we break this down a little further. We look at small cap growth versus value, and it's not really moving to the upside. It is in an uptrend, but it had pulled back when we were going down. As we're going back up, now these are small caps, so they're not at their all-time high, but we would want to see this ratio really going up if we're more positive on growth versus value. We look at the mid caps, also not really breaking out, in fact, going sideways and not really showing a lot of strength currently. And we're seeing that same thing with S&P growth to value. We want to see this ratio really going up. At least that's what we had been seeing. Now we're wondering, is the market starting to shift into a different climate where it's okay for value to do better? And there's some other areas that I'll talk about later in the video that could be causing a bit of a concern. We want to be aware of those, but it doesn't necessarily mean the market's falling apart either. We look at inflation. This is a monthly chart of the CRB index where it's pretty much been chopping sideways, but it's still in a longer term uptrend. And then we do a ratio between inflation and deflation, and we're still going down. The moving average is going down, even though it has been coming back up recently. It's just showing that inflation is not necessarily a problem, according to this chart, based on a monthly view. We look at the CRB index, and you can see all the different components that make up the CRB. It had been in a solid uptrend, started to pull back. It's still in an uptrend, but now it's falling below its 50-day moving average. We look at the Baltic Dry Index, which also has been spiking up and then coming back down. We look at this because this is used by some investors to say, how much does it cost to ship products from point A to point B, specifically in the Baltics? And when this is going up, that tends to be inflationary. When this is going down, that tends to be more deflationary. Now, some folks like to shift this around and look at this in different ways. I just look at the S&P on top, and I look at the index down below. Some other markets that we just want to keep an eye on to see what's happening, where aluminum is now in an uptrend and starting to go higher. That could be somewhat inflationary. Corn is bouncing back up. It came up to its 200-day moving average and now is starting to come back down. Wheat also has been bouncing back up, getting really close here to seeing an uptrend. That could be inflationary. We keep an eye on fertilizer, where it really has been declining over the past few months when looking at this chart. Oil, which really spiked up when things started to escalate in Israel. Lately, it's been falling back and we're under 80. Gas, which is in an uptrend, but it has been pulling back, starting to bounce off of its 200-day moving average. And diesel also has been pretty much declining over the last few months, because this is how much does it cost to ship products using trucks and railroads. Heating oil, which is going down and is in a downtrend. Natural gas, which has really been getting hit. It's starting to bounce back up, but it's not in an uptrend at least yet. Copper, which has been really strong, and we call it Dr. Copper because when copper's going up, that tends to mean the economy's looking good going into the future. When it's going down, that can suggest economic weakness. Well, it's really been on a tear, and it's going back and setting highs here as other parts of the market have also been going up. We look at a ratio between copper and gold, and both of them have been doing quite well lately. Copper's been going up, gold's been going up. When we look at this ratio, it shows that copper had been underperforming. Now we're starting to see a golden cross here where copper is starting to outperform gold. Here's a longer term chart of that same thing showing the ratio in black where this ratio has really been coming up. I also plot the 2-year yield and the 10-year yield on here. There are times when we get pretty close and we tend to go in the same direction based on the 2-year yield, but there's been a wide spread now for the last few years, and we're wondering if the overall climate is starting to change. We look at gold, the ETF. I do follow the futures contract, but in this video, I mainly just cover the ETF, where it is in an uptrend. It really started to break out. It pulled back, didn't get down to its 50-day moving average, and now is starting to go back up. Silver has been doing really well, and it's actually outperforming on a shorter term basis. And we look at the relationship between silver, gold and silver, and you would think that they would have a pretty high correlated relationship. And right now that's true. On the bottom, this is when this gets a really high reading, that means there's more of a 1-to-1 relationship between gold and silver, as both of them have really been breaking out lately. And we do a study. We take a gold to silver ratio. When this is going up, that means gold is outperforming. And now we see over here on the right-hand side where they're both going up, but silver has been outperforming gold when this ratio goes down. And then sometimes we can get some insight by plotting the US dollar index in the middle. And as a general rule, we're seeing a stronger correlated relationship here. But when the US dollar index goes up, gold outperforms silver. Well, the dollar has been under a little bit of weakness lately. So when the US dollar index goes down, silver outperforms gold. And that's what we're seeing right now in a more general sense. Not necessarily anything that we do, just something that is kind of nice to be aware of. Here's the dollar index, which is still in an uptrend, but it has been pulling back. It got up into the 106 range. Now it's falling into the mid 104 range. And here's a longer term look where we did break out above this trend line here, but now we're starting to come back down slightly. And the dollar going down actually helps stocks. That helps on a conversion basis, because when the dollar is weaker, it looks like they have more dollars on their books if they convert from a foreign currency. It also is more advantageous from an import-export vantage as well. So that's why we keep an eye on the dollar. If it's really lately anyway, if it's going down, that's been helping stocks to go higher. And the inverse of that is also true. We look at the euro, which is really close. The moving averages are right on top of each other, which has been coming down in relation to the US dollar. And we keep an eye on the Japanese yen, which is really in a downtrend compared to the dollar as well. So I have some breakout charts. Here's the euro to the dollar, and you can see the moving averages are almost on top of each other. As the euro has been starting to outperform, it was underperforming. If this keeps going up, we'll probably see the euro continue to outperform the dollar itself. It's just barely trying to make some kind of a trend change right now. Here's the Japanese yen, which really started to go up. There was some speculation that the Japanese government stepped in to prop up the Japanese yen against the dollar. Well, that's kind of been fading now as the the yen is in a downtrend compared to the dollar. Here's the British pound, which is still in an uptrend compared to the dollar and starting to show a little bit of strength as the dollar has been weaker. And we look at some other indexes. I do show this in each daily video now. We look at the S&P 500, which is a weighted index, and we compare it with an equal weight index. And there's not really that big of a difference between the two right now, as we're seeing the broad market participate more in the up moves that we've been seeing in 2024. Here's a similar look where we look at the ratio between the equal weight and S&P, and I kind of flipped it upside down. When this is going down, that means that the equal weight is underperforming. So longer term, it's still the big stocks that are really having most of the control, but we've been chopping around for a lot of 2024 so far. We're not seeing like the Magnificent Seven and the real large caps. They're not massively outperforming as we see the rest of the market show some improvement. We look at a ratio between stocks and commodities, where stocks are outperforming commodities with this ratio. Here's an inverse showing how commodities are underperforming stocks. The NASDAQ 100 versus the S&P 500, we're getting close to seeing a death cross here. Now, it's the NASDAQ 100. That's where the big Magnificent Seven stocks are and the big tech companies that everybody loves. But we're seeing it starting to underperform the S&P. That's not necessarily negative. That just means that the rest of the market is actually starting to show some improvement. But when we really see sustained uptrends like we have been since the October 2022 lows, that's when we see this ratio really outperforming. And now it's kind of settling back at the present time. We look at the S&P 100 and compare it to the S&P 500. This is holding up. And there are big stocks in the S&P 100 as well that are part of the large caps. And so this is still looking healthy just on this ratio basis. We look at the NASDAQ compared to the S&P 500, and they both have just recently set all-time highs, but we've been going sideways now when we look at the NASDAQ. Typically, we would see the NASDAQ outperforming the S&P in solid bull markets, and it still is. And this is not necessarily a warning sign, but usually we would see this ratio going up. And then we look at the NASDAQ 100, which are the biggest stocks that make up the NASDAQ. And this is actually showing a death cross with this ratio. Again, that it's just showing that things are changing a little bit. It's not the really big stocks that are controlling the market right now. It's some of the smaller stocks are coming in and actually taking over some leadership. When we were coming up in 2023, we saw the NASDAQ 100 really outperforming. Now we're starting to see it underperform slightly. And we look at the mega caps, the really big stocks, and compare it with the equal weight ratio. So it's not a massive change because this is still in an uptrend showing that the big stocks are outperforming, but it's not going down the way you would expect this as we were really coming up earlier in 2023. Then we look at small caps, which are still lagging behind. They had an up week, but they're just at the high end of their current range that they've been in. That's the red line here. And when it's going down, that means that small caps are underperforming. We also compare it to the S&P itself, also showing that the small caps are in a downtrend when compared to the S&P 500. Now, if we look at the small caps by themselves, they're doing good, not great, but they're doing good. But on a ratio basis, they are underperforming the broader market. The biggest software companies not really breaking out to the upside. This is part of tech. They're still in an uptrend, but we came down and actually fell below the 200-day moving average. Now we're bouncing back up, but we're not really breaking out right now. Here are the mega caps, and this still is the strongest area of the market where we're in an uptrend. Both of the lines are going up and prices above both of the moving average lines. Robotics and AI, this has been all the rage now. We're finally seeing some strength. Over the past week, there's going to be a new version of ChatGPT, and then Google made a big announcement with Gemini, their version of AI, and that's giving some support to this ETF. But when we look at it on a ratio basis, it's actually underperforming the tech sector. Now, it's still positive, but on a relative basis, this is really not showing a lot of strength all by itself. This is the Dow Jones Composite Average, which takes the Dow, the transports, and utilities, and this is going up. Now, for a lot of the end of 2023 and into 2024, a lot of the strength in this average was coming from the Dow, where the transports and the utilities were really lagging. The transports are still lagging, but the utilities have been really strong lately, and so that's really helping this to go up higher these days. We look at the S&P and compare it with shorter term bonds. When this is going up outside of the rainbow, that means stocks are outperforming, and that's more positive for the stock market. We look at the S&P 1500 and compare it with shorter term bonds, showing that on a broad market basis, stocks are also outperforming. Another broad market measure compared with 3 to 7 year bonds shows that stocks are outperforming. And this is a total US stock ETF made up of 2,651 stocks. It's setting all-time highs, just showing that there's more broad market participation. Low volatility. This is what folks like to get into when they're concerned about market conditions. When we look at this by itself, it is in an uptrend and it's above both of its moving averages. But when we do a ratio between the low volatility ETF and the S&P, it's really underperforming. And we look at the tech sector and compare it with bonds. After pulling back into the rainbow when we had our decline in April, it's now starting to break out of the rainbow. And then we look at some other stocks, and I show this in the daily video as well. This is the advanced decline line studies for the NYSE common stock, the S&P, the mid caps, and the small caps. And we're holding up fairly well right now. This is Dow theory, where we look at recent all-time highs with the Dow. In fact, it closed over 40,000 on Friday. But you can see just by looking at this how the transports have really been going sideways and underperforming. But then you look at utilities on the bottom, and they're just screaming to the upside right now. And I'm going to address this here a little bit more in depth. We look at the transports. We want to see this doing better than it has been. That would give more support to the market, but it's just not. It's not coming back to previous highs, either more recently or back into 2023, let alone the all-time high set back in 2021. Then we look at a ratio between the transports and the S&P, and when this is going down, that shows how the transports are underperforming the S&P. We look at the Dow to transports and take a ratio. When this is going up, that means the Dow is outperforming. And we look at the relationship between the S&P on top and the transports, and they're kind of neutral right now. The S&P has been really solid. Transports have not really been solid, so their correlated relationship is starting to not really mean that much at the present time. And we take a new idea behind Dow theory. Instead of using the Dow, we might use the S&P 500. Maybe that's a better representation of the US economy. And then instead of using transports, since we're a tech-based society now, we use the NASDAQ instead. Well, we're setting recent all-time highs with both, and these are more or less confirming each other. And then we break that down a little bit more. Instead of using the S&P, we use the S&P equal weight, which is coming back, getting really close to setting all-time highs. And instead of using the NASDAQ, we look at the QQQs, which is the NASDAQ 100, and take an equal weight look at that. And this is not quite back to setting an all-time high yet. So this is not necessarily confirming what we're seeing in the main indexes itself, but this is still looking positive for the time being. This can rectify itself if things continue to go up. The FANG index is coming off of setting a new all-time high and is in an uptrend. This is Facebook, Apple, Amazon, Netflix, Google. There's NVIDIA in there and some other stocks. But this is just showing how the big stocks that everybody seems to know their name, they continue to hold up fairly well, even though some of the Magnificent Seven stocks are in downtrends when we look at a 50 period versus a 200 period moving average. And I keep this chart on here just in case we see some weakness to try to find out some areas of potential support if we fall. So this is not really relevant right now since we've been going up. The Wilshire is another broad market index setting a recent all-time high and is in an uptrend. ARC, which is just not really participating. It was all the rage back in 2020 and into 2021, and then it went on difficult times. And it's in an uptrend, but you can see the 50 period is rolling over, and we're not really seeing a lot of the bounce up that we're seeing in other areas of the market. Now, this is a new one. This is All World taking out US stocks, and this is an ETF put out by Vanguard showing that we are coming back and setting all-time highs with the All World Index. So it's like, well, maybe I should get some foreign exposure, and that might be a good idea until you look at this chart, where we're still seeing that the S&P is outperforming the stocks in the rest of the world. Now, it's still in an uptrend with this ratio, showing that the S&P continues to outperform. If this really starts to come down, then that's when folks might consider looking at some foreign type investments. Then we look at a monthly chart of the S&P and another global area with stocks in Europe, Asia, Australia, and the Far East, showing that the S&P continues to outperform. This is a monthly chart, and so we're above a long-term trend. We're rolling over a little bit with the percentage price oscillator, but again, it can take some time for this indicator to actually move, and we just want to keep an eye on this longer term. Now we look at bonds, where we're seeing some improvement with bonds based on price. They're still in an uptrend. They came down to their 200-day moving average and were able to bounce up off of that, and they're currently above their 50-day moving average. If bond prices go up, that means interest rates are going down, and that's more friendly for stocks. This is a Pring World Bond Index where it's been really choppy right now, and it can't decide if it wants to go up or down, and it's just barely hanging on to an uptrend. We look at a monthly chart of stocks versus bonds, showing that stocks continue to outperform. This is kind of that same thing, but shorter term, meaning a daily chart. When this is going down, that means that bonds are underperforming stocks. Then we have high yield corporate bonds. They're also called junk bonds, coming off of setting recent all-time highs. And these can be riskier, but they also give folks a better yield, and that's why they're willing to get into them. If we see an environment where it looks like interest rates have topped out and are starting to come down, that's when folks will get into the safer treasury bonds, because they'll lock that yield in for a longer period of time, and this will likely start to come down. But for right now, the junk bonds are holding up quite well, and it tends to follow the stock market fairly closely. These are investment grade bonds. These are more conservative bonds. They have a long ways to go to get back to their all-time high. They are in an uptrend. They came down to their 200-day moving average and are now starting to bounce back up, even above their 50-day moving average. Then we do a ratio between riskier bonds, meaning junk bonds, and more conservative bonds. We're coming back down a little bit, but still it shows that folks are preferring to have the riskier bonds. They're willing to take on that risk to get a higher yield. We look at a correlation between stocks and bonds, and it's pretty high right now. So if stocks based on price and bonds based on price, they're having a tendency to be up and down at the same time currently. We look at the corporate bond index, which is bouncing up a little bit. It's still in a longer term uptrend, but it's really been going sideways for most of 2024. We keep a Fibonacci measurement here with the 10-year yield. We're kind of in between, not really showing anything. This is a longer term chart where for 40 years, we were seeing a series of lower highs and lower lows as interest rates were going down. And now we're thinking, okay, are we going back to a higher interest rate environment, which would really be the norm? The 40-year period here, that's not the norm. To go to a higher interest rate environment would be more of what has happened historically. But since this lasted 40 years, you've got a couple of generations of investors who've never been through that kind of an environment before, and money managers and hedge fund managers and so forth. So this is causing a little bit of concern with interest rates going up. And that's why we're seeing when interest rates go down, that really helps stocks go up. Here's another Fibonacci measurement based on the 30-year yield, not really showing us anything insightful. Then we look at the S&P and compare it with the 10-year yield. We were coming down as we were seeing some weakness in April. We finally bounced around a little bit and lately have been starting to break back up, showing that stocks are outperforming the 10-year yield. And I've been showing this in the daily video. When this is going down, that means the bonds are underperforming. This is a ratio between 3 to 7 year bonds and the S&P 500. If we're to stay more positive with the S&P, we want to continue to see this ratio go down. Here's the junk bond ETF all by itself, coming back and setting recent all-time highs. Then we do a ratio between junk bonds and more conservative bonds. And even though they're pulling back, it's showing that junk bonds continue to outperform. What we're going to be waiting for is if this really starts to come down as interest rates potentially have topped out, that's what we would expect to see here. But we're not seeing that yet. Here's just a chart of the 7 to 10-year treasury bond based on price. We broke above the 50-day moving average, and now we've been falling back just a little bit. The RSI, although it's coming down, is still above 50, but the shorter term momentum since the beginning of May has been positive for the price of bonds. Here's a daily chart of yields showing how we had been going up. Then as we've been coming down, that's been giving some more support to stocks. We look internationally, where a weekly chart shows that US and UK rates as well as German rates declined the past week, but Japanese rates are continuing to go up. And there's an interesting thing happening in Japan right now that I've been addressing in the daily video off and on, just on an as-needed basis. Japan owns a tremendous amount of US treasuries, and they're trying to prop up their yen, and they've been using cash, well, yen, to do that, to try to stimulate their currency because they don't want it to get too low. Well, if it gets to the point where they have to start selling US treasuries to help support things going on in Japan, that could put pressure on interest rates. Because if they're selling an awful lot of US bonds and then different maturities that they have, then that pushes prices down and interest rates up. So we just want to be aware of that situation. Then we look at a thing called the MOVE Index, which measures the volatility of bonds. We also look at the VIX, which measures the volatility of stocks, and they both have been really dropping lately. Their relationship is not all that strong right now, but this is not measuring price. This is just measuring volatility of stocks and bonds. And we have a monthly chart of the 30-year ETF showing that it is in a downtrend right now. It's below its moving average. And then we do a ratio between the 30-year ETF and the CRB commodities, showing that even though we've been in a decline, the price of the longer-term bond is still outperforming commodities. Then we look at different sectors. And first we look at just the sector all by itself, and then we compare it with the S&P. There are 11 sectors that make up the S&P 500. And I just do this based on the alphabetical version of their symbol. So B comes first. So that's why you see this chart first. These are materials, which when you look at them by themselves, they are in an uptrend. When we compare them to the S&P, they were bouncing back up, but now they're starting to fall back when compared on a ratio basis. We look at communication, which is in a really solid uptrend all by itself, and it's actually not doing great. This has been one of the stronger areas. Now, it's still in an uptrend, and it could still show some improvement from here, but it hasn't been breaking out the way we have been seeing it in the past as the market has been recovering from the October 2022 lows. Energy, which is in an uptrend all by itself, it had pulled back in April. Now it's starting to go back up. But when we look at it compared to the S&P, it's really continuing to underperform, and it's in a longer-term downtrend on a ratio basis. We'll look at the financials, which continue to be strong all by themselves. And even when we compare them to the S&P, not really breaking out to the upside, but they're in an uptrend and slightly outperforming the S&P. Industrials, which are in an uptrend all by themselves, but they saw some weakness over this past couple of days, and so they're still in a longer-term uptrend, but they have been falling back with this ratio. The tech sector, which is the darling that everybody loves, it saw some weakness in April, starting to show some improvement, and it's not really outperforming right now. It's showing some improvement. It's breaking above the moving averages, and it's still in a longer-term uptrend, but it's not breaking out the way we saw this in early 2024. We look at staples, and this is an area that's causing a little bit of a concern. This has been in an uptrend going back to the October lows in 2023 and just continues to go up. And this tends to be more of a defensive area of the market. Folks get into this because these are things that you have to have no matter what's going on in the economy. And the fact that this is doing strong is causing a little bit of a concern, and I've been dealing with this in the daily videos. But when we look at it on a ratio basis, staples continue to underperform the S&P. Real estate, which was seeing some weakness as we were going down, is now starting to go back up and really chopping sideways, but still in a longer-term uptrend. But when we compare it to the S&P, it's really continuing to underperform. And utilities, another area that tends to be more defensive. This has just been screaming to the upside now, and I wanted to bring up a longer-term chart here, and we're in an uptrend. And they're even starting to outperform a bit on a shorter term basis with the ratio, but they're still in a longer term downtrend. This is another area that we've been a little concerned about, staples and utilities. And we do a ratio, and this is really going down right now. For the S&P to be more positive, we want to see this ratio going up. And I've been showing this a lot in a daily video. And the reason why this may not necessarily be a bad thing is a gentleman named Jason Gepfert. He runs a site called sentimenttrader.com. And I got this from Twitter. This is just showing how utilities and staples are the first sectors to reach 52-week highs. Now, this is a few days old. This is before we were setting all-time highs on Wednesday and Thursday and somewhat on Friday with stocks. But he says here, stocks have been recovering since the April pullback, but most indexes are still off the highs. Not now, but this is at the time he posted this. Based on where they were earlier in the year, most sectors too, except for two, the most defensive ones. This is where people get into when they're more concerned about the market being under pressure or going down. Bears suggest that if staples and utilities lead the charge higher, this rally is not to be trusted. And I've been bringing that out in the daily video. But historically, based on what he's found, the S&P did just fine going forward. Over the next 6 to 12 months, there were only 2 losses out of the 12 signals. So yeah, this is different, and we're wondering if we're changing the climate a little bit inside of the stock market. And this can mean, because this is what we saw right at the end of 2021 before we ran into 2022. And so that's bringing up some warning signs right now, but it doesn't always necessarily mean it's going to lead to something negative. We just want to keep an eye on this. And healthcare, which is in an uptrend when you take it all by itself, but it's in a downtrend when we compare it to the S&P. Discretionary, which has really been underperforming, it's still in an uptrend. It's coming back up to its 50-day moving average. But when we look at it based on the S&P, see, this is Tesla. These are the fun things in life, which this usually goes up, this ratio, when the market is really going up as well, but it's not really happening right now. And that's another little warning sign that we're keeping an eye on. Semiconductors, after seeing some weakness in April, they haven't set all-time highs yet, but they have been seeing some strength. They're still in a longer-term uptrend. And we compare energy with tech, showing that energy has been underperforming. It was starting to bounce back up, but now it's coming back down, meaning that energy is still underperforming tech. We look at growth stocks compared with bonds based on price, and it's probably not a real surprise where growth stocks are outperforming bonds. And the tech sector to the 10-year yield, this has pretty much been chopping sideways, but now the tech sector is showing some improvement, and it's still in an uptrend and has been for most of 2024. Here's an inverse of that same chart showing how the 10-year yield is underperforming the tech sector. Discretionary to staples. This is another area that we would want to see this ratio going up if we're more positive on the market based on how we've been seeing the recovery from the October 2022 lows. This ratio is now going down when we compare discretionary to staples. And discretionary had been outperforming, but now it's starting to underperform. Here's an inverse of that same thing, where staples were underperforming. Now they're starting to outperform. And we look at gold, which finally saw a golden cross here on the daily chart. We're also seeing this on the weekly chart. It's now outperforming the S&P. As gold has been going up and now the S&P is going up, we've been seeing this ratio coming back just slightly. And we look at gold to the dollar, where it broke out above this trend line and is still outperforming the dollar right now anyway. High leverage loans, I like to point this out. These are very risky loans. And these are these are some pretty smart people that know about what's going on in this area of the economy. And you can see we're just in a solid uptrend and barely came down and kissed the 50-day moving average and continue to go up, and pretty much day after day, it seems, set new all-time highs. This gives us more confidence that things are looking okay in the economy. Now, personal economy may be totally different, but according to high leverage, very risky loans, things are looking pretty good. The NYSE composite in an uptrend, setting a recent all-time high. All stocks also coming off of a recent all-time high. Emerging markets are starting to show a little more improvement and are in an uptrend, but have a ways to go to get back to their all-time high. And the Japanese Nikkei, that's their main index over there. It finally broke out above highs set back in 1989. It since has been pulling back and is trying to make a run again towards that 1989 level. Microcaps, smaller companies, are in an uptrend. They saw some weakness in April, but now they're bouncing back up as well. And we would keep an eye on the home builders. We're not really getting any insight from this right now. When we see the top chart and the middle chart really deviate from each other, that's when we see these yellow marked areas. We're not really seeing that right now. So we're not getting any concerns from this chart. Bitcoin, which went all the way up to 73.8 as far as its price, has since been pulling back. Now it's been getting back up into the high 60s again, and it's still in a longer term uptrend. Internationally, we're in an uptrend with Chinese stocks, emerging markets, Europe, Japan, and the US. So we're seeing pretty much global stocks all advancing now. Here's an intermarket analysis chart showing that now gold is in the lead, going back to the beginning of 2024, followed by oil, and then stocks, and then the dollar, where bonds are still negative so far on the year based on price. We look at some correlations. We look at the S&P to the dollar, and they're having a real strong tendency to go in opposite directions right now. So if the S&P is going up and the dollar is going down, that's what we're seeing when we see this inverted correlation. We look at S&P to oil, which is pretty much neutral right now. This was really starting to spike up when things were escalating in Israel. Since then, it's been taming down a little bit here. And we look at the S&P to the 10-year yield, also going in opposite direction. So that's why we keep an eye on the 10-year. If it's down, that gives support for stocks to go up. And of course, the inverse of that is also true. We look at tech versus the 10-year yield, also going in opposite directions. And then the S&P to the 2-year yield, also fairly strong tendency to go in opposite directions. Then we have some long-term secular and cyclical chart studies. This is a monthly chart of the NYSE where we're coming back and setting all-time highs, and we're above the moving average. So that's looking quite positive. We use the Copic curve to measure momentum, and that is still looking positive on a longer-term basis. And this is a broad market measure. We look at a daily chart of the NYSE, and then a thing called the NYSE Record High Percent Index, that's continuing to go up as well. So shorter term on a daily chart and longer term on a monthly chart, we're still looking good there. Here's the S&P monthly chart. It's above the moving average, and we're starting to turn back up with the percentage price oscillator. So this is showing some improvement. And then we look at the S&P on top, and then we take a ratio between stocks and commodities on the bottom, showing how stocks on a longer term basis continue to outperform commodities. And here's another global index that we look at where we're still in an uptrend, showing that the S&P is outperforming. The KST, which is another momentum oscillator, a little longer term, takes a while for this to turn. It's pretty much flat right now. And then at the very end of this, I go through and list all the positive things. And my definition of positive for this video is when the 50-period simple moving average is above the 200-period simple moving average. And it's a pretty long list, so this is kind of small writing here. The growth indexes, value indexes, copper, the British pound when compared to the US dollar. Now that's kind of close right now. The gold is in an uptrend, silver, the dollar, the CRB index, the big software companies, the mega caps, the FANG index, ARC, low volatility stocks in the S&P, staples, the Dow Jones Composite Average. All of the different bonds that we look at based on price are still in uptrends. The tech sector, as well as semiconductors, high leverage loans, the Dow, the NYSE composite, as well as the Wilshire, which is another broad market measure. The NASDAQ and NASDAQ 100, the mid caps, small caps, and micro caps, all stocks, emerging markets, and Bitcoin. These are all in uptrends. Now, the negative side, and it's pretty short right now, it's when the 50-period simple moving average is below the 200-day simple moving average, and we have the Japanese yen to the US dollar. It's in a pretty solid downtrend. What's barely is kind of teetering back and forth is the euro to the US dollar. So we see more weakness in the dollar. That would probably help the euro, and we could put this back on the other side when we look at the overall trend. Thank you. I really hope you found this helpful. You might find this video useful and helpful and everything, but it's not necessarily meant to be a standalone video. my main video is the video that I post each day. This is something that I do once a week, and I use it to analyze what's going on in the broader market. And then ultimately, I focus on the daily chart. So feel free to check that out. I hope you have a really good weekend, and I will talk to you in the next video.